right. Hey, everyone. This is Kirk here again at Option Alpha. Thank you so much for being here with me today. Big thanks to the team at Tradier for inviting me to do this show. I'm really excited about doing this show with you guys. And so this is our first episode here today. Got a really good one teed up for you because I think it wraps up a lot of different topics and conversations around trading and how you can trade and what you can do. And hopefully what I can do today is just educate you a little bit on a particular topic that is near and dear to my heart and should be to yours as well if you're a trader and you trade based on math and probabilities. And then also, if we have a little bit of time, I can show you how we use it inside of Option Alpha. So we'll jump right into it here and start with some of the slides. If you guys want to bring up the slides, we'll bring those up. And what I want to talk about today is expected value, or what is commonly referred to as EV. Now, it's a harder topic to understand, but I hope that we can break it down. But I wanted to start this whole series and show series here with Tradier with this topic because for options traders, I think it's one of the most important concepts that you can grasp. Now, whether you choose to use expected value moving forward, or you choose to completely ignore it, you don't believe in it or whatever, the concepts that I think you'll learn in just trying to educate yourself about probabilities and expected outcomes and risk reward, I think will serve you moving forward for all of your trades. So if I do nothing else on here, hopefully I can teach and educate you on what expected value is, why you should care, and how you could possibly use it for your trades. So that's purely our goal here. As always, if you have any questions or comments, you just leave them in here. If I don't get to them here while we're on the show, then I'll get to them afterwards in the comments when we go from here. Okay, so moving forward. So let's talk about what is expected value. So expected value, or what is commonly referred to as EV, is purely a fundamental concept in probability theory that provides this insight into the outcome of value, or the value of a random variable set. And so there's a lot of terminology and words. So basically what it means, to put simply, or to put it in English, is EV is the weighted average of all the possible outcomes. And so what it does is it serves as this powerful tool for decision-making and risk assessment. It's a way for us to take all these outcomes and all these possible outcomes of a potential trade or betting system or game or betting game and try to determine, hey, is this something we should put our money behind? Is the expected outcome of all the possible activity and all the possible outcomes that could come with this, is that something that leads me to potentially gaining an edge or making eventually some money in doing this? So let's start this by considering a betting game. I just wanted to start this in the most simple terms possible because I promise if you just follow along with this betting game analogy, as we go through here, we'll just continue to build and build on top of what we're learning, and you'll start to see why calculating expected value is so important to your trades. So let's consider a betting game where it doesn't have to be a coin flip. It's just a game. Could be a coin flip, could be heads or tails, could be thumbs up, thumbs down, doesn't matter. But there's a 40% chance of winning and a 60% chance of losing. So the odds are slightly tilted, right, against you, that you could have a 60% chance of losing and a 40% chance of winning. If you win $500. If you lose $200. So there's a 40% chance of winning $500 and a 60% chance of losing $200. So the question is, should you play this game? Do you have an edge? Now, most people would look at that and they go, well, I don't know. Like, it looks like there's a 40% chance of winning, so I'm not going to play the game. But we know that's not the end. That's not always the story, right? It's not just the win rate. It's not, I'm going to win 50, 90, 100% of the time, whatever. It's not just the win rate. You have to take the win rate combined with the risk, the reward, and the risk profile of what the game is. So in this case, the question you should be asking is, again, should you play this game? Now, you can answer this in your own mind. You can answer this in your head. But you're ultimately trying to figure out, and the math side of me as a trader would try to figure out, do I have an edge in playing this game? And so here's how we would figure out that edge, is we would try to calculate an expected value. Now, this is really easy because there's only two binary outcomes. You either win or lose. It's $500 or it's negative $200. You lose $200. So what we do is we take a calculation, a very simple calculation, to determine the expected outcome of this simple betting game. So that calculation goes something like this. The expected value, EV, is the amount of money that you will win, which is $500, times the probability of winning. That's 40%. You add that to the amount of money you will lose times the probability of losing, which is 60%. When you get all those numbers and you kind of finally compress them all the way down, you see here that your expected outcome of the entire game, all the wins and all the losses and all the money you could make and all the money you could lose, is about $80. So this particular betting game, if you were to play this game, has a positive expected outcome. I wish I could see everybody in here doing this, but if that makes sense, you guys let me know so we can keep moving forward on this. If you have questions, let me know. But it makes sense now that even though my win rate is not super, super, super high, right? I'm only winning 40% of the time. When I win a lot of money. When I lose a little bit of money, and net, it gets me to the point of having a positive expected outcome. The outcome is when I play this game, I should be up $80 playing this game. That makes sense. Hopefully it does as we keep going. Okay. Now the next question you should be asking yourself was, does this mean that every bet, or AKA every trade in this game, will be profitable? So let me go back a little bit. I said that you win, and when you win $500. And when you lose $200. Does that automatically mean, because the expected value is positive, does that automatically mean that every single trade or bet will be profitable? Hell no, it doesn't. Don't know if they have explicit on here. Don't know if this qualifies as explicit. It doesn't matter, but hell no, it doesn't. It doesn't mean that every single bet will be profitable. And that's the biggest misconception about expected value. Expected value is taking a calculation based on lots and lots of occurrences, not based on one single binary random outcome or even a string of outcomes. And so how do we prove this? Well, we prove this by just figuring out that every single bet could be a winner or loser. And what matters is the expected outcome, the future outcome of many, 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 many trades. Okay? So if we were to prove this using a coin flip, to use the analogy and just keep working this forward for our betting game, if you flip a coin and you do heads or tails, what is the likelihood of getting heads on the first flip? It's 50%, right? That's the likelihood of getting heads. But let's say after the first coin toss, you actually have a heads. So now your proportion of all coin tosses that you've done is you have 100% heads. Does that mean that the coin is broken? No. And everyone probably agrees with me on this, but it doesn't mean that the coin is broken. It doesn't mean that the coin is lopsided. It's a scam coin. It just means that you still have a 50% chance of getting heads if you keep doing lots and lots of flips of the coin. And so you can see in this study that this guy did, Statistics by Jim, he flipped a coin 200 times, and basically you can see how the probability, or the expected outcome of that coin toss started to consolidate or converge around its expected outcome, which is 50%. So in the beginning, after 11 flips, you can see it here on the chart here, after 11 flips, you were getting significantly more heads than tails. 60, 70% of your flips, so that's 7 out of 10, 8 out of 11 of those flips were heads. Again, that doesn't mean that the coin is broken. It doesn't mean you're a genius. It doesn't mean that you know how to pick heads or tails if you call it in the air. It just means that you haven't had enough occurrences of that coin flip. But eventually, if you have enough occurrences, it will start to converge on its expected outcome, which is a 50% probability of hitting heads or tails. So when we talk about expected outcome, we are not talking about a single occurrence. We are talking about pricing trades, pricing your risk management to account for the fact that you're going to be here for a long time and doing lots of trades and in this business for a while. and making sure that you're taking on enough risk and premium to compensate you so that you actually do have the odds slightly stacked in your favor or tilted in your favor if you manage your book appropriately between here and lots of occurrences. So to put a hammer into this point, though, it's not that it's just going to happen one time, just like this did for this particular sequence of trades. If you were to do this trial of heads and tails over and over and over again, like sets of 1,000, so you would flip a coin, track all the heads and tails from 1 to 1,000 flips, stop it, reset the numbers, track it all over again. You can see that early in the cycle of trading or flipping coins or whatever your betting system is, you're going to get lots and lots of volatility. Sometimes you get a lot more tails, sometimes you get a lot more heads. Ultimately, it's going to continue to converge, and all systems converge eventually to their expected outcome. It's just exactly how it is. It's just the math and probabilities of how things are priced. And so traders who are brand new, they see lots and lots of volatility. Things are really good, they're really bad. Ultimately, it really doesn't matter until you get to lots and lots of trades. And this is where it matters the most, that your actual pricing of trades was actually favorable compared to unfavorable, okay? So let's switch the math around, and now let's play the same game, but with different stats. And hopefully you guys are still enjoying this as I go through this, but let's play the same game with different stats. So we know originally that game had really, really good stats. So let's switch the math around. Now let's assume that this time there's only two things that can happen. You can either win or lose on the game. There's a 1% chance of winning. And if you win, you win $100. This is the classic investing strategy. People like this. You can call it the lottery strategy. Like people do this all the time, right? Very small chance of winning a large amount of money. Classic lottery example. So 1% chance of winning $100. Now there's a 99% chance of losing. And when you lose $2. So again, the question is, should you play this game? Do you have an edge? If you were to play this game over and over and over and over again, would you win playing this game? Now, some people would say, well, I could win the first time. Like there's a 1% chance. So maybe you get lucky and the first time you play, you get $100. Maybe the next time you play, you get $100. But then what happens after lots and lots and lots of times playing this game? And that's where you have to ask yourself, do you have an edge in this game? So we're going to calculate the expected value of this game. What is the expected value of this game? Just purely based on the outcomes and the probability of each of those outcomes occurring. So we take $100, which is our amount of money that we could win. We multiply that by the probability of winning, which is 1%. We add that to the amount of money we lose and the times the probability of losing that amount of money. So notice here, $100 times 1% chance of winning the $100. We're going to lose $2, and there's a 99% chance that we lose $2. At the end of the day, when we sum all of these calculations up, we get a negative 98 cents. So this game, the expected value of playing this game is negative. It means that if we keep playing this game, we will consistently lose over time. In fact, the more we play, the more likely it is that we will lose playing this game. Could you get lucky and hit a couple hundreds? Of course. But the more you play this game, the more likely it is that you lose playing this game. And hopefully you can see here that now it becomes apparent that if you're trading and you're trading with expected values that are negative, it is highly likely that over time you will lose making those trades, even if those trades have a high probability of success. And I'll show you guys some examples as we go through here, but even trades with a high probability of success, you still need to make sure that the expected value of the things you're looking at are positive, so you at least have the odds tilted in your favor before anything even happens beyond trade entry. Okay, so look, the same concept can and should be applied to the selection of option trades. And that's really what we're focusing on here. So we went through the two betting examples, but now we're going to transition to option trades. You can call bets just trades. They're just trades. just a risk calculated trade against a win and a loss and a probability of making money and a probability of losing money. You can figure out the expected value. So let's apply this to an example trade. Let's say that we are looking at a very simple bull put spread. This is a bullish option strategy. Typically, you would have this strategy where you would sell these put options net. It's a net selling strategy. You would sell the put options below where the stock is trading. So let's say the stock is trading at $60 or $70, something like that. You sell the 50 strike put, you buy the 45 strike put, and you collect some sort of premium. In this case, you collect $100 of premium. So in the max case scenario, if you win on this trade, you win $100 of premium. If you lose on this trade, you lose $400 of premium. And if we know the probability of getting to $50 or $49, or the expected probability of getting to those points, then we can start to build out some expected value calculations here. So here's a simple expected value calculation for this potential trade. Let's assume that there's a 70% chance. Does that show up when I do this? Yeah, it does. Okay, cool. Let's assume that there's a 70% chance that I win on this trade. There's a 70% chance that the stock stays above the 50 strike. Maybe the stock is already at 60 or 65. Whatever it is, there's a 70% chance that it stays above 50. So if I look at my expected outcome formula, there's a 70% chance I capture $300. And there's a 25% chance that the stock falls below my lowest strike, which is at 45. So there's a 25% chance that I lose $400. So even though this trade on its face is a high probability trade, selling options out of the money, all the good things that you love about options trading, even though on its face it's a high probability trade, when you actually do the math and you see where it ends up, you can see that this trade does not have a positive expected outcome. Now, I just picked out these numbers. This is not every single trade that's like this. I'm just showing you some numbers to show you how the math can work out to be a negative expected outcome for things that look like on the surface level are high probability trades. And again, we'll show you real examples using real data as we go through the session today, okay? But this trade right here has a negative expected outcome of $30, which means that you really shouldn't take this trade. That you should really, there's got to be extenuating circumstances essentially for you to want to take this trade, because right now, just based on pure math and probabilities, it doesn't look like you're being compensated enough. You need to win more money, or the probability of winning needs to be higher, or you need to lose less money, or the probability of losing needs to be lower. Like something has to give in this system for this thing to work out. Now, option trades are not strictly binary, full loss or full profit trades. In this case here, you can see there's something in between here. There's a difference between the 50 strike and the 45 strike. There's a sloping P&L line here. So in our last example, just to kind of help build on the example that we had before in the betting game, we used a binary approach, which was max loss, max win. But that's not how options really work. In the real world, option trades are not strictly binary. They're not full loss or full profit all the time. There's times when you're trading with spreads particularly where we need to account for all outcomes between the strike prices. And this is where we get into a true expected value calculation. So in a true expected value calculation, we not only need to account for the probability of making our maximum potential profit, and we not only need to account for the probability of making our maximum potential loss, but what we also need to account for, let me see if I can draw some shapes in here. What we also need to account for, I guess you guys can see it here, this is that gray shaded area, is we need to account for all of these partial profits and partial losses as well. Like what if the stock lands at 53? Then we don't have max profit, but we have some profit. Well, what is the probability of getting to that point? And what's the expected outcome if you include all of those partial profits and partial losses. And what you end up getting is you end up getting a more true and accurate representation or estimation, I guess you can say, of what the expected value is of a potential trade. And where a lot of people fall flat is they only do the binary max loss, max profit. What they don't do is they don't do this partial profit, partial losses zone, which is really important. It could literally be the difference between taking a trade or not taking a trade. And it also helps you get a full picture of what the actual trade is worth. Okay, so hopefully that makes sense as we keep going through it. So let me switch over to the computer now, or to, let me just stop that one. Let me switch over here. And I'm going to show you an option alpha. Hopefully this works. There we go. Okay, switch over to that one, guys. Okay, cool. So here inside of option alpha, we do that calculation for you, essentially. So I'm going to go over here to positions. Actually, I'll go over here to trade ideas. So inside of our platform, what we do is we do this calculation for you. Now, you could do this calculation on your own. You could pull down the data. You could use other services to do it. You could use another broker to do it. We feel like it's a really important thing that people should do. And so we do the calculation for you. We allow you to use it inside of your bots. We allow you to, filter by it. We allow you to rank by it. It's a component of your trading. Is it the end all be all? No, of course not. But I want to show you some different examples of how you can look at expected values to see how anytime, at any point, you have trades that are good potential trades would have positive expected value, or at least that's like one component of a good trade. And then you have trades that just don't have the pricing that makes it worth it. And this is really important because as a trader, you need to know, am I taking on trades that are compensating me essentially for the risk involved in this trade? And we don't know the future, and we don't know what the future outcomes are going to be. But based on what we do know now about the stock or the underlying and expiration, all these things, am I taking in enough premium for these trades? All right, so let's take a look at this. So I'll just filter here by ETFs inside of, so this is like taking all the universe of things that we support and filtering by ETFs. And what I'm going to do is I'm going to filter the probability of profit for 70% or higher. And I'm going to reverse sort this list for negative expected value trades. Okay. I'm doing this on purpose to show you deliberately what a bad looking trade looks like. Because in this case, right now, the pricing on this trade is not great. And in fact, it's not even covering the actual risk of the trade. So if I open up this trade here, here's what you see. You see that this is for XLY. And so we can look up specific tickers if we want to as we keep going forward here. But you can see XLY is trading at 167, 36, 37 and change as it starts to move, right? And this is showing that the 157, 163 put spread, remember the short put spread that we looked at before? This is a bullish strategy where we're selling options out of the money. So look, our short put strike is at 163. The stock is trading at, or the ETF is trading at 167. So we're selling options out of the money. That particular put strike has, or this trade here has a 71% chance of profit. Now, again, if you just looked at that, which is the easiest thing to look at, lots of platforms show you the probability of profit, or they calculate a probability of profit. Some of them do it differently. We might do it differently than other platforms or have different little nuances in there, but it's generally the same calculation, or roughly the same that most people use. But if you just look at the probability of profit here, you would look at this trade and say, hey, this is a really good trade. And from a probability of profit standpoint, yes, it's a high probability of profit trade. The probability of reaching max profit is 67%. That's really good too. The max profit, if we price the trade at 121, which is the current mid, is $122. So you've got a 67% chance of capturing the full $122 profit. Now, I'll just say this one disclaimer as I go through here. I forgot to mention this earlier. All the expected outcomes are at expiration. So they're not calculating expected outcomes from today to tomorrow. No, it's at expiration. So in this case, September 29th, which is, I think, the quarterlies. Yeah, so the quarterly contracts here. Now you have the probability of max loss. There's a 14% chance that you get max loss, which is $480. Now, these are the known variables. These ones right here, these variables down here, those are known. Those are our binary outcomes: max loss, max profit. We know those. What we do is we also calculate in between the strikes, that slope of the line in your P&L diagram that calculates all the little possible outcomes between your two different strikes, where it's not a binary full max loss, full max profit. And when you add up all of those and all their expected outcomes, what you get is a net number that is negative. So what this means as a trader is that if you took this trade and if you actually made lots and lots and lots of trades just like this is assuming that probabilities play out perfectly, and we know there's some fluctuation in there, that if you made this trade, you would probably win 71% of the time or something very close to that. But the amount of money that you're taking in and the times that you would win are not going to cover the times that you lose and how much you lose during those occurrences. So hopefully that makes sense. It's a really powerful thing that if you don't understand this now, this is why sometimes you will see traders, or you'll feel it yourself, where you're like, gosh, I'm winning 70% of the time. I'm winning 60%. My trades are going the right way, but I can't seem to keep my head above water. Well, this might be one of those factors. I'm not saying it's the only thing. I'm saying it might be one of the most important factors, is actually taking trades that have a positive expected outcome, that have the odds where you're actually capturing enough money. Now, if you look at it on its face, you can see this trade is $120 when it wins and $480 when it loses. It's just not covering it enough. If you look at some of these other ones here, let's look at a different one like GLD. GLD, this is an iron condor. It's calculating, again, all of the possible outcomes for this trade. You can see, again, high probability of success. This trade is a high probability trade. If we were just judging this trade off of wins and losses, this one would be a good one to take, like high probability. But you're not capturing enough money. It's not paying you enough money to actually cover the risk that's embedded in this strategy. And so for that reason, if you were to make this trade over and over and over and over and over again, it probably wouldn't go anywhere. In fact, it would go negative because you're just not covering enough money. You're not making enough money when you win to cover how much you lose when you lose. Now, if we flip this around and go the opposite direction, so let's go this way. And I don't know, sometimes you could take really, really crazy ones that have a lot more risk obviously involved in them. So some of these ones have a lot more risk. So let's kind of filter these by alpha here. So let's look at some of these, and I'll just go to like SPY, for example. Let me just filter for just SPY. You can see like this is a good example of a trade. Well, let's take this one here. Some of these ones are shorter duration. How about this one right here? Okay. This is an interesting example of a trade. This one is an iron condor strategy, has very short strikes together. So the stock is trading at 442, it's selling call options right above there. Some put options got a little bit more room. But overall, you're taking in a pretty high premium with a pretty high probability of profit for the next couple days. Your loss is lower than your max profit, and it's a lower probability. So the expected outcome on this trade is positive. Now, does this mean you're going to win $117 on this trade? Hell no, it doesn't. I just want to make sure that's 100% clear. That's the expected outcome of lots and lots of occurrences like this. And obviously, if the probabilities are a little different, or if you interject and take trades off early, those might shift those probabilities. But at least you're getting into a trade where the odds and the math is slightly tilted in your favor. If you go to some of these other ones like this SPY Iron Condor, it's about 16 days out. You can see that it's about a 50-50 push in your max profit and your max loss on this trade. So in this case, if you were to take this trade, and right now, like the way that it's pricing, if it was $150 for a $3 wide spread on either side, right? Is that $3 wide spread? Yeah, $3 wide spread on either side. It's like even max loss, max profit, like dollar for dollar. But when you calculate the slope of the line and the probability of profit, this looks like a pretty good trade where you have at least some premium stacked in your favor. Right now, the market is favoring you taking this trade over some of the other trades. Now, I'm not saying the market wants you to take this trade. I'm saying like that's how pricing is. It's more advantageous to take this trade than it might be to take a trade that has negative expected value. So hopefully that makes sense. Now, I've been running my own experiment on this to do this across multiple bots inside of a paper trading account. I call it the pure EV strategy. You can follow along on YouTube. We've been doing this. But basically what this is doing is it's just looking for pure expected value, positive expected value, high probability also trades, and it's just making those trades. And what's kind of interesting about this is if you go into the analyzer for the pure EV, it's done about 296 trades so far. Its win rate is about 70%. And you can see that it's actually taking in enough money to cover the risk net. Now, it's had some volatility in the beginning for sure. So that's okay. I fully expect that maybe this peak that it's going through right now would come back down and we get some drawdowns again, and then some peaks, and then some more drawdowns and some peaks, because again, we need lots and lots of trades for it to finally normalize around its win rate. But you start to see that just using pure EV without any other market influence, no IV rank, no technical filters, no nothing, just trying a pure expected value approach. And this, again, just a testing portfolio that I am testing out myself and then would make changes and hopefully look to go live because we just released this feature just recently. But this is a really interesting way to look at a trade. If you do have other positions, and let's say you want to get into a new position, one of the cool things that you can do is just price it out here. Just see if a trade makes sense. So actually, let's look at bonds. Bonds, I think, have been super oversold. Doesn't mean that they're going to stay that way. So let's go in and do the short put spread. We'll go and do monthlies out in October. We'll select our short strike. Maybe we'll select that around like a 90. And then we'll do our long strike, maybe at 87. I don't know. We'll start there. Okay. Right away, you can see as soon as we calculated this, this trade has a negative expected value. So right now, I would not take that trade, even though it's a really high probability of profit. So what can I do in here? I can go in here and start to adjust these to see if any adjustments that I make to this trade start to make this trade make more sense. Maybe it does. Maybe there's a point at which it makes the trade make a lot more sense. So here it starts to make a little bit more sense. At least it's positive expected value, but it's kind of fleeting. It doesn't really, oh, now I just clicked too much and I'm messing around inside the platform. But you can see that you can modify this to kind of shift the probabilities out to different dates. You can change the expirations, you can change the strikes that you're using, and we'll recalculate your expected value. So this is a good way, if you understood what we went through here today, this is a really good way for us to use expected value to inform some of the trades that we're doing and some of the decisions that we're making for our portfolio. Because if we're not collecting enough premium on some of these trades, then it's just not worth it for us to be making some of those positions. So let me go here. So this one's November. We'll go to the November. We'll just tighten this up just a little bit. And you can see this is still a positive expected trade, a positive expected value trade out in November. It's 93 days out, so maybe that's too far. We back it into October. Okay, that's 65 days. I mean, this is all just what you want to do as a trader and what kind of fits your risk tolerance. But you put this trade on and you're making $92. You're certainly risking a lot, but overall, you've got a really high probability of profit, and the expected outcome is $4.91. Now, I don't know if I would take this particular trade. That's a huge risk. You probably have to make sure your account size is big enough to, take in a bunch of these, but you certainly could look at some of these and say, hey, I want to take in some of these potential trades. Okay, so hopefully that helps out. Let me just go back to the slides here, just recap before we go back at the end of the day here. I know we got another show coming. Let me share my screen. Whoop, I just killed myself there. Let me share the screen. And we'll go back to the slides. So just to recap here really quick, what we are trying to do as traders is we are trying to eventually get to the point where we can calculate the full expected value of our trades. On this example here, this is a short put spread, which we just went through. We looked at a lot of examples of this, but if you are not calculating the full expected value of your trades, I would strongly consider you try doing it. Try figuring out what trades you're getting into and the expected value of those trades moving forward. Don't forget that you don't want to look at just the binary outcomes, which means you don't want to look at just max profit and just max loss. That will definitely give you 80% of the picture, 90% of the picture. But what you're missing most of the time is you're missing the partial profits and partial losses. And that's calculating every single potential profit or loss along this slope, or multiple slopes if you're looking at iron condors and iron butterflies, and then factoring those into your calculation as well. It's something we do by default automatically for you. But if you don't use us, you can do it yourself in a spreadsheet or using a computer or whatever. But make sure you're calculating those as well. Because in my opinion, if you don't have at least some sort of slight statistical edge in just the premium that you're collecting on your trades, it's really not going to work out in the end. If you're not collecting enough premium to cover the risk, you're probably just shooting yourself in the foot and you're going to be churning your account. So anyways, hopefully that really helps out. So that pretty much wraps it up here for me today. If you guys have any other questions or have any other comments, please let me know in the chat down below. I really hope you enjoyed this first series and show here on Tradier Hub. If you guys need anything, please let me know. And I think that pretty much wraps up. So anything else we need, guys, on your end on the backside? Okay, cool. Sounds good. You guys need me just to log out. I don't know how we end this thing. You guys just let me know as we go. We'll be all good. Sounds good. Hey, everyone, have a really good end of your day. Until next time, happy trading. Take care.